So what is accounting exactly? Quite simply, accounting is the process of recording, analysing and summarising the financial transactions of an entity. And by entity, we typically mean a business. So let's break down this definition into its three component parts. So first we start with recording. Recording means capturing all of the entity's transactions, whether it's a sale, a purchase, a payment received. Each transaction needs to be logged. 30 plus years ago, this was done predominantly by hand using physical ledgers, but today most businesses use computerized accounting software to record their data quickly and securely. Once we've recorded the transactions, we move on to analysing. This step is all about interpreting the numbers. Are sales increasing? Are costs under control and not rising? Is the business making a profit? This analysis helps managers understand the business's financial performance, spot trends, and catch any mistakes and accounting errors early on. And then finally, we come to summarising. Here, we take all of the detailed data and present it in a meaningful, simplified way. The data is used to produce reports like the income statement and the balance sheet, which gives a big picture view of the business's financial performance and health. Modern day accounting software can automate this entire process. It can help record the information, assist with the analysis, and generate polished reports all at the click of a button, saving an accountant's time and reducing the risk of errors. So, in a nutshell, accounting turns raw business data into valuable, insightful information following a three-step process, which is recording, analysing and summarising. When it comes to profit-focused businesses, there are three main types. We've got sole traders, partnerships and companies, and each comes with their own pros and cons. We'll start with sole traders. This is where a single individual owns the business. They keep 100% of the profits if the business is successful, but they also take on all of the risk if it fails. Common types of sole trader businesses include shopkeepers, plumbers, hairdressers, and the key point to remember is that sole traders face unlimited liability. This means that if the business runs into trouble, the owner could lose their personal assets, like their home. Next, we have partnerships. This is where two or more people come together to run a business and share in both the risks and the rewards. Partnerships are particularly common in professional fields like accountancy firms, law firms, and there are two different types of partnerships. We have first general partnerships, which is where all of the partners share in the unlimited liability, and we also have what's called limited liability partnerships, or LLPs, where the partner's liability can be restricted. And then finally, we have limited companies, which offer a very different level of protection. These businesses are separate legal entities from their owners, who are known as shareholders. Crucially, shareholders benefit from limited liability. Their personal assets remain protected even if the business fails. Each business structure has its strengths, and the right choice will depend on the wants and the needs of its owners. The key difference is that in a company, shareholders benefit from limited liability, meaning that they can only lose the amount that they paid for their shares when they bought into the company. Their personal assets are safe. In sole traders and partnerships, the owners can potentially lose their homes because they face unlimited liability. So if the business fails, they could lose their home, their car, their personal wealth. Businesses produce different types of financial information, which we can divide into two categories. We have internal and external financial information. Internal financial information is used by the people who run the business on a day-to-day basis, and it's not shared with outsiders. It includes things like management accounts, budgets, forecasts, and these are all types of reports that help managers make decisions, track performance, and plan ahead. This type of information is often produced monthly or even weekly, and it's tailored to fit the needs of different departments within the business. On the other hand, external financial information is prepared for people outside of the business, like investors, banks, regulators, and even the wider public. These reports include the statement of profit or loss and the statement of financial position, and increasingly businesses are also publishing sustainability disclosures, which includes info about their environmental impact and their social impact. External financial reports are typically produced annually, sometimes quarterly, and they need to follow strict rules and standards such as IFRS and the UK Companies Act to ensure accuracy and consistency. In summary, both internal and external information are important. Internal information helps managers steer the ship, whereas external information helps influence the decisions made by investors, lenders, and regulators. So, why do businesses prepare financial statements like the income statement and the balance sheet? Well, according to the IFRS conceptual framework, the objective of financial statements is to provide information about the reporting entity that is useful to existing and potential investors, lenders, other creditors, when they're making decisions about providing resources to the entity. Put simply, financial statements exist to help people make informed choices about the business. Investors, for example, want to know whether to buy, hold, or sell their shares in the business. Lenders want to understand whether the business is likely to repay its loans on time, and suppliers need to know whether the business will be able to pay them for the goods they supply on credit. So financial statements give these stakeholders a window into the business's financial health and its financial performance, showing whether the business is generating profit or loss. They also provide information about the business's ability to generate future cash flows, which is essential for planning and decision making. So while preparing financial statements may feel like an administrative requirement, the true purpose is to give investors and other stakeholders the information that they need to confidently make economic decisions about the business. When investors and lenders review a business's financial statements, they ask three key questions to help them make those sound economic decisions. First, they ask, what economic resources does the business have? In other words, what does the business own they can use to make money and grow? This might include things like cash, property, machinery, equipment. So understanding the resources that the business has available helps users assess its ability to generate future income. Second, what does the business owe? These are the business's liabilities, such as loans, outstanding payments to suppliers, or other debts. Knowing how much a business owes gives users a clearer picture of its financial obligations and its risks. And thirdly, users look at how efficiently the business's managers are using its resources to generate a profit. Are the managers making good use of the business's assets? Are they delivering high returns on the investment made into the business by both the providers of debt and equity capital? And this information helps users judge not only the health of the business, but also the quality of its managers. And one of the most important determinants of a business's health is its cash flow. It's not enough for a business to just be profitable. If cash isn't coming into the business when it's needed, the business may not survive. So what is cash flow? Cash flow simply refers to the movement of money in and out of the business. What investors really care about is the timing and certainty of cash flows when assessing whether the business is stable and financially healthy. A business needs reliable cash flow to do four essential things. First, to pay its employees and its suppliers on time. Second, to meet its interest payments on its debt. Third, to repay its loans on time to avoid the risk of default. And fourth, to deliver returns to its shareholders either through dividends or by reinvesting back into the business to fund future growth, which will increase its valuation over time. So even businesses that are profitable can quickly run into issues if the cash it expects to receive doesn't arrive on time. If a business doesn't have the cash that it needs to pay off its debts, it will fail and go out of existence. So this is why cash flow information is such a vital part of financial reporting. Financial information is used by a wide variety of people, all with different needs. On this slide, we'll run through the main users and how they actually use financial information. So firstly, we have managers and directors who are responsible for running the business. They need up-to-date financial data to make informed decisions about pricing, production, hiring, financing and investing, as well as monitoring the business's performance. Owners or shareholders want to know how well the business is performing so they can decide whether to buy, hold or sell their shares in the business. They're especially interested in profitability, risks and whether the return on their investment is worthwhile. Lenders, such as banks, use financial information to decide whether to provide loans to the company. They'll assess whether the company can meet its debt payments and will often ask for cash flow forecasts from the business's managers. Suppliers use financial information to check whether a business is financially stable enough to pay for its supplies. They also are interested in how it treats its workers, its stance on fair trade and sustainability. HMRC uses financial data to assess how much tax a business owes. Employees want to see that a business is doing well and can continue to employ them, pay sufficient wages and offer good working conditions. They also care about things like equality, ethics, and how the company treats its staff. Financial analysts use reports to provide insights to their clients, whether that's investors, journalists, credit agencies. They help advise investors on whether the stock is a buy or a sell. Information is also used by credit agencies who want to advise less lenders as to whether to extend credit to the business and on what terms. Customers want to know that the company is financially secure and reliable so that they can rely on them for repeat purchases and also to provide an after-sale service. Governments and government agencies use aggregated financial data to monitor the health of the overall economy and inform national policy. Financial information is used by governments to ensure the fair allocation of resources over the nation that they preside and to provide a basis for their national statistics. And then finally, the public, regulators, are also increasingly interested in how businesses and their activities impact broader society. This includes everything from job creation to their impact on the environment. So regulatory bodies are using financial statements to make sure that businesses are following the rules and acting lawfully. So as you can see from this slide, financial information serves a wide variety of purposes. Understanding who's using it and why is a key step in learning how accounting supports better business decisions and creates public trust. One of the key challenges in financial reporting is the information gap. The information gap exists because internal users such as directors have access to a wide breadth of financial information that external users such as investors don't have access to, such as real-time data, forecasts, budgets. Instead, external users can only rely on public financial statements and disclosures that are published by the business annually. And this means that external users are at a huge information disadvantage. They don't have a complete picture when they're making decisions about whether to invest, lend or extend credit to the business. The information gap highlights why trust, transparency and accurate reporting are so important. Good financial reporting helps to reduce the size of the information gap and gives external users the confidence they need to make informed decisions. So without reliable information, the information gap could lead to poor decisions and huge financial losses for investors and lenders. So to reduce the information gap, businesses often produce tax reports for HMRC, cash flow forecasts for banks considering lending to the company, so that the bank can understand whether or not the company will have sufficient cash flow to be able to meet their interest payments. Each stakeholder focuses on different types of information. So for example, managers monitor performance metrics using internal operational data, whereas shareholders assess profitability and risk by analysing the financial statements. Lenders and creditors care more about whether the business is able to repay its debts on time and in full by generating sufficient cash flow. HMRC needs accurate profit before tax numbers so it can calculate the tax due from the business for the year. Employees want to ascertain their job security and ensure that they're receiving sufficient pay. Analysts want to compare a business's performance with that of its peers. And the public and government agencies use financial data to evaluate the business's ESG impact. So, professional accountants must uphold high ethical standards. If stakeholders can't trust the financial information that's being prepared by accountants, they won't be able to rely on it when making economic decisions, and the value of accounting as a profession will break down. That's why applying sound judgment and being ethical is essential for maintaining confidence in financial reporting. Let's try a quick sample exam question to check your understanding. Which one of the following issues in an entity's financial statements is likely to be most of interest to the entity's owners? So is it option A, the amount of corporation tax owed to HMRC? Is it option B, the return on investment and profitability of the company? C, the credit terms offered on goods sold? Or D, the emissions levels? So the correct answer is option B, the return on investment and profitability of the company. And the reason why is because shareholders are primarily interested in how well the business is performing financially. They want to know whether the company is generating profits and whether the return they're receiving justifies the risk they've taken by investing in the business. This information helps them decide whether to buy more shares in the business, hold on to their investment, or sell down. And in terms of why the other options are incorrect, A, the amount of corporation tax owed is certainly important, but it's mainly of importance to tax authorities like HMRC. Option C, the credit terms offered on goods sold matters mostly to customers, especially those who are buying goods from the business on credit. And option D, the emissions levels may well be of interest to regulators and some ethical or ESG focused investors in the company, but for most owners the core financial focus remains on profit. So when it comes to financial statements, owners are primarily interested in profitability. The way financial statements are prepared is shaped by an intricate web of laws, principles and standards that ensure the information users rely upon is consistent and reliable. Several key factors influence how accounting is carried out. We have GAAP, or generally accepted accounting practices, a set of guidelines that shape how financial information is reported. Alongside this are accounting standards such as IFRS, which explain how to account for different types of transactions. One fundamental accounting principle is the idea of showing a true and fair view, ensuring that the financial statements give an accurate picture of the business's financial position and performance. And accounting is also shaped by accounting concepts such as accruals, going concern, and consistency, as well as by the use of judgment, where the rules require interpretation and flexibility. And increasingly, businesses are expected to share information on their ESG impacts alongside their financial results. In the UK, all companies need to comply with the Companies Act. The Companies Act is legislation which lays down legal requirements for how companies must prepare their financial statements. It places a legal obligation on companies to report high quality financial information. And all of these factors together create a regulatory framework that keeps the accounting profession meaningful and trustworthy. GAAP. So GAAP stands for Generally Accepted Accounting Practice, and it's a set of guidelines that shapes how financial statements are prepared and presented. The main goal of GAAP is to ensure that financial information is useful to the people who rely on it to make economic decisions. GAAP ensures that financial information has 4 key qualities. It must be relevant, helping users make decisions. It needs to be reliable, so free from significant errors or biases. It needs to be comparable, so that the information can be compared across time and between different businesses, and it needs to be understandable. Presented clearly so users can follow the story that the numbers are telling. These principles are also built into IFRS, so regardless of whether we follow IFRS or GAAP, the objective of accounting is the same: to provide financial information that supports good decision making. In the UK, the financial reporting requirements for companies depends largely on whether the business is listed or unlisted. Listed companies, those whose shares trade on a public stock exchange like the LSE, must follow IFRS. Listed companies need to follow IFRS because these standards are designed to promote transparency, consistency, and comparability across international markets. In contrast, unlisted companies, so these are private businesses that don't offer their shares to the public, generally follow UK accounting standards such as UK GAAP, as opposed to international accounting standards. It's also worth flagging here that certain companies may qualify for financial reporting exemptions under the Companies Act and may not be required to prepare full financial statements. So certain small companies can produce more condensed balance sheets, enjoy reduced disclosure requirements, might not need to prepare a cash flow statement. The definition of a small company is based on having low turnover, small balance sheet sizes, and a low number of employees. Cool. So in summary, the financial reporting rules a company needs to follow depends on the size of the business and whether it's listed or unlisted. So when preparing financial statements, many accounting principles like prudence, materiality, and the matching principle require judgment, but applying judgment introduces subjectivity. Different accountants may interpret the same transaction in different ways. This can lead to inconsistencies both between companies and across different reporting periods for the same company, making it much harder for users to assess the business's performance or compare financial positions. So for users of financial statements, like investors, this lack of consistency can present a real challenge. If the information isn't prepared on a consistent basis, it's difficult to make informed decisions for users. And that's the reason why accounting standards exist. Accounting standards create clear accounting rules to reduce subjectivity and promote consistency, ensuring that similar transactions are recorded in the exact same way, so increasing comparability. Internationally, standards are set by IASB under IFRS. In the UK, the Financial Reporting Council issues UK standards like FRS 102. And then in sustainability reporting, the ISSB has been formed to create rules for ESG reporting. So together, all of these standards help ensure that financial reporting is reliable, transparent, and useful. The International Accounting Standards Board, or IASB, is the global authority responsible for setting accounting standards. The IASB issues 2 main types of standards: the International Financial Reporting Standards, or IFRS for short, and the International Accounting Standards, known as IAS. While they may have different names, IFRS and IAS standards hold equal status. The key difference is that IAS are older, they were issued before 2001, whereas IFRS standards have been issued much more recently. Alongside the standards themselves, the IASB also issues interpretations through the IFRS Interpretations Committee. These include IFRIC interpretations and SIC interpretations, both of which clarify how certain standards should be applied in specific scenarios. All of these standards and interpretations are underpinned by the conceptual framework, which outlines the fundamental concepts that guide the presentation of financial statements. In the UK, unlisted companies have two main choices for their financial reporting framework. They can either adopt IFRS standards or they can follow UK reporting standards known as FRS. When we refer to UK GAAP in this context, we're talking about a combination of the Companies Act and UK accounting standards, the most important of which is FRS 102. FRS 102 is the core standard that applies to most issues in UK financial reporting, and while FRS 2 follows international terminology, the Companies Act follows and uses UK specific terms. As a result, non-listed companies in the UK typically use the Companies Act format, even when applying UK GAAP. And we'll explore some of these differences further in the section on company financial statements later in the module. A key requirement in preparing financial statements is that they must give what's termed a true and fair view. But what actually is a true and fair view? Well, a true view means that the information in the financial statements is factually accurate. It reflects what really happened using correct figures and data. A fair view means that the information is presented in a balanced, unbiased, and complete way. It doesn't hide or distort important facts. It gives users a clear view and clear picture of the business's financial position and performance. So together, a true and fair view means that the business's financial statements are both accurate and honest. They don't mislead users, and they faithfully represent what's going on in the business. It ensures that financial statements are trustworthy and decision useful for investors, lenders, and other users of the financial information. Cool. Let's look at a practice question. Which of the following organisations sets accounting standards in the UK? Is it the IFRS Interpretations Committee? Is it HM Treasury? Is it the Financial Reporting Council? Or is it Companies House? So the correct answer to this question is C, the Financial Reporting Council, or FRC. The FRC is the UK's official standard setting body. It develops and maintains the UK's accounting standards, including FRS 102, through its codes and standards committee. And then in terms of the other options, the IFRS Interpretations Committees helps clarify international standards, but it doesn't set UK rules. HM Treasury is responsible more for public finances. It's not responsible for accounting standards. Companies House is a registrar. It collects and publishes company filings, but it doesn't set the standards that companies need to follow from an accounting perspective. So what you need to remember from this sample exam question is that when it comes to UK accounting standards, it's the FRC that leads the way. So this next section of the material focuses in on sustainability and how sustainability relates to accounting and financial reporting. Now, sustainability is a relatively new topic in the ICAW certificate level exams. It wasn't around when I studied, so I do recommend making sure you are clear on the following concept because it is going to be tested, and in my opinion it's quite easy marks. So let's start by briefly defining sustainability. Sustainability can be defined as meeting the economic needs of today's generation without endangering the ability of future generations to meet their own needs. So why does this matter for businesses? Because their activities, from the way they source materials to how they treat their employees to the impact they have on the environment, all have consequences that stretch well beyond their profits. Increasingly, investors, regulators, customers, and society at large expect businesses to act responsibly, to think not just about their financial results, but about their broader impact on the world around them. It's true that environmental issues like climate change dominate the headlines, but sustainability is much broader. It also includes social issues like human rights, employee welfare, and impact on community, and governance issues such as leadership ethics, executive pay, and transparency. These three areas together are known as ESG, environmental, social, governance. Focusing on all three helps ensure that a business is not only financially successful, but also acting in a way that's ethical and sustainable over the long term. Making sustainability disclosures is becoming a vital part of financial reporting. But why is sustainability reporting so important? Well, investors, lenders, regulators, and customers increasingly want to know more than just the company's financial results and profitability. They want to understand the business's wider impact on the environment and on society. Users of financial information are asking important questions. How is the business's activities affecting the planet? How does it treat its employees and local communities? Is it well governed and managing risks responsibly? And crucially for investors, how might these issues influence the company's future success and valuation? Poor environmental practices can lead to fines and reputational damage. Social issues like poor labour conditions can affect staff morale and customer loyalty. Weak governance can lead to poor decision making and even financial scandals. So all of which can have a negative impact on a company's valuation. Accountants play a vital role in sustainability disclosure by applying their skills in measurement, analysis, and reporting to ensure that ESG information is credible, consistent, and useful for decision makers. While it's great that many organisations have taken the steps to disclose sustainability information, the lack of consistent standards means everyone is reporting slightly different things in different ways. This inconsistency makes it difficult for users of financial information to compare one company's sustainability performance with that of its peers, as well as creating a challenge in understanding how certain ESG factors are impacting company valuation. In response, governments around the world are introducing laws which standardise sustainability disclosure and encourage businesses to internalise their environmental and social costs. This internalisation means that ESG practices, particularly poor ESG practices, will now show up as costs on the income statement, reducing a business's profit, therefore creating a financial incentive for businesses to adopt more sustainable behaviour. However, these regulations can only work if the data being reported is accurate and reliable. That's why key bodies like TCFD, ISSB, and GRI come in. They provide guidance to help standardise sustainability disclosure, making it easier for businesses to report on their sustainability efforts clearly and consistently. The IASB was formed in 2021 by the IFRS Foundation. Its mission is to develop a global set of sustainability disclosure standards that work alongside existing IFRS financial reporting standards. These standards focus in on helping companies report not just how they impact the world, but also how environmental and social factors might impact their financial future. The ISSB has outlined two key pillars of sustainability reporting: impacts and dependencies. Impacts measures how businesses' activities and actions affect the environment or society, such as its carbon emissions or its labour practices. Dependencies, on the other hand, focuses more on how external conditions and factors like climate change or new regulation that's being introduced affect the company's ability to operate and create value. So impact looks at the actions of the business and how they impact the environment and society, whereas dependencies looks at how changes in society and the environment impact the business and its valuation. So while the ISSB provides these key frameworks, it's up to national governments and regulators to enforce their use in company reporting. So let's now take a look at ISSB in a bit more depth. The ISSB was established to improve the quality of sustainability disclosure across companies and across countries. Its aim is to give investors better insight into how ESG factors could impact a business's long-term performance. Initially, the ISSB's standards focus specifically on climate change and climate-related disclosures, building upon the growing global concerns about climate risk, but since it's become a lot broader. It's also important to know that ISSB does not create laws itself. It issues standards, much like the International Accounting Standards Board, and these standards can only become mandatory if national regulators such as the FCA in the UK decide to adopt them into law. The ISSB also builds upon existing frameworks such as the Task Force on Climate Change related financial disclosures, or TCFD, and the Global Reporting Initiative, or GRI. These earlier initiatives laid the groundwork for ISSB's sustainability reporting. And finally, it's important to clarify that ISSB standards do not replace existing accounting standards. They sit alongside IFRS and IASB. In other words, financial reporting and sustainability reporting are complementary to one another. They're both designed to help users understand an entity's full performance and full risk profile. So, to summarise this slide, the ISSB's initial focus was on climate change. Its standards are voluntary, they're not mandatory, and it builds upon existing sustainability frameworks, and it doesn't replace IFRS. It works in parallel with IFRS to enhance the overall transparency of corporate reporting. In 2023, the ISSB released its first two standards. You have Standard 1, the general requirements for disclosure of sustainability-related financial information, and you have its second standard, climate-related disclosures. These standards are designed to help investors better understand how ESG issues such as climate change, resource scarcity, and social risk affect a company's valuation over time. Both standards became effective for reporting periods beginning after the 1st of January 2024. However, again, it's important to note that these standards are not mandatory. They're not laws, and the ISSB does not have the power to enforce them. Instead, each national government or local regulator within each country must decide whether to adopt these standards in their jurisdiction. Some may choose to make them mandatory, while others may offer them as voluntary guidance. So, in essence, the ISSB sets global sustainability disclosure guidance, but it's up to local regulators to decide how and if they're going to use them. So let's start off by focusing on the first standard, which outlines the general requirements for companies disclosing sustainability-related information. The purpose of IFRS Standard 1 is to ensure that entities provide information about sustainability-related risks and opportunities that could reasonably be expected to increase or decrease the entity's enterprise value or its valuation, basically. These disclosures are useful for investors who are keen to understand the ESG factors that impact a company, because these factors will inform their decision whether to invest in it or not. So, IFRS Standard 1 structures these disclosures around 4 key headings: governance, how the organisation's board and management oversees ESG risks and opportunities; strategy, how these risks and opportunities are integrated into the company's strategic planning, risk management, the processes used to identify, assess and manage sustainability risks, and fourth and finally, metrics and targets, the KPIs the company uses to monitor and manage its ESG targets. IFRS Standard 1 also asks companies to report on impacts and dependencies. Impacts are how the company's actions affect the world around it, like the environment and broader society. For example, a business's production process might cause air pollution, or it might contribute to deforestation when obtaining its supplies. So examples of impact include how a company's activities affect human rights, worker conditions, health and safety policies, pollution, greenhouse gas emissions, and the use of natural resources like water and land. Dependencies are environmental or social systems the company relies upon and from the world around it to keep it running. For example, a drinks company relies on access to clean water, and a tech company relies on skilled, educated workers. Other examples of dependencies are stable climate conditions, public trust, regulatory support. These are the core things that the company needs to succeed and maintain or even increase its valuation. While IFRS Standard 1 addresses sustainability as a whole, IFRS Standard 2 dives deeper into climate change risk specifically. IFRS 2 recognises that climate change is one of the most urgent threats to businesses today. Therefore, companies need to make disclosures in their financial reports pertaining specifically to climate change. The second standard uses the same four-pillar structure as Standard 1, governance, strategy, risk management, and metrics and targets, but applies it directly to climate-related risks and opportunities rather than to generic ESG-related risks and opportunities. One of the most important parts of IFRS Standard 2 is its classification of climate change risks into two main categories. First, we have physical risks. These risks refer to the direct physical damage caused by climate change, such as the damage caused to the company's assets or any disruption to its business operations or supply chains caused by more frequent and severe weather events, so floods, droughts, hurricanes, heat waves, all of which have a negative impact on a business's valuation. Transition risks are the financial risks businesses face as the world moves to a low carbon economy. These include stricter emissions laws, which may limit the level of production a business can undertake, higher carbon taxes, which increase the cost for high emission businesses, shifting consumer demand, which can reduce sales of less sustainable products, pressure to adopt green technologies, which may require costly investment by the business. Together, these two risks can reduce profits, increase costs, and decrease a company's valuation. So in short, IFRS Standard 2 gives investors a detailed view of how financially exposed a business is to climate change related financial risks. Cool, let's take a look at another question. Which two of the following are examples of sustainability impacts caused by an entity? So this question is designed to test your understanding of the difference between impacts and dependencies in sustainability reporting. So option A, the emission of pollutants into the local water supply. This is a strong example of an impact. It shows how the company's activities are affecting the environment directly. This kind of outward effect is exactly what we mean by a sustainability impact. Option B, the reliance on stable climate conditions for agricultural production. This sounds important, and it is, but this is more of a dependency. The business depends on external climate stability to function, making it something the business relies on rather than something it causes. So this is definitely a dependency. Option C, the introduction of fair labour practices across the supply chain. This is another clear impact. This represents the organisation's influence on working conditions and the broader social environment. Positive or negative, these effects are considered impacts. And then finally, option D, the availability of skilled labour in the local community. This is another dependency. The company depends on an educated and skilled workforce to operate effectively. It's not something that the company is directly causing. So, to summarise, the correct answers here are option A and option C. These are both examples of impacts because they show how the organisation affects people or the planet through its actions. So now let's introduce the financial statements that a business needs to prepare every financial year. These 5 financial statements tell the story of a business over a particular time period, helping users understand where the business stands financially and how it's been performing. First, we have the statement of financial position. This is often called the balance sheet, and it shows the business's assets, its liabilities and equity at the end of the reporting period. Think of it as a snapshot of the company's financial health at a specific point in time. Next is the statement of profit or loss, commonly known as the income statement. This shows the revenue earned and the expenses incurred during the reporting period. It tells us whether the business made a profit or a loss and gives insight into overall performance. Then we have the statement of changes in equity, which tracks movements in the owner's interest in the business over the course of the reporting period. The statement includes things like profits retained in the business, retained earnings, any new capital introduced, and dividends paid out. Next, we have the statement of cash flow that shows how much cash is moved in and out of the business during the reporting period. It answers the vital question, does the business have enough cash to keep running? And then finally, we have the notes to the financial statements. These provide detail which helps to explain the numbers, including the accounting policies used and any other relevant information that helps users interpret the figures within the income statement and the balance sheet correctly. So together, these 5 financial statements form a complete and transparent picture of a business's financial position and performance, and throughout this module we'll explore each one in more detail and show you how to read and interpret and even prepare each statement for yourself. The statement of financial position, often called the balance sheet, is one of the most important financial statements. It provides a snapshot of the company's financial position at a particular point in time, showing what the business owns, what it owes, and the owner's stake in the business. On one side of the balance sheet, we have the business's assets, which includes things like cash, inventory, property and equipment. On the other side, we have its liabilities, which is its loans, amounts owed to suppliers and any other debts. And the balance sheet also shows equity or capital, which is essentially the owner's share of the business after all liabilities have been settled. Put simply, equity or capital represents what's left for the owners once all of the debts have been paid off. So this includes amounts invested by the owners, such as share capital, as well as any profits that have been kept in the business, which are known as retained earnings. So in simple terms, the statement answers the following question. Where does the business stand financially right now? Is it in a good bill of health, or is it looking quite unstable? That's what the balance sheet answers. And it also follows the core accounting equation, assets equals capital plus liabilities. This is a key relationship that will come up time and time again over the course of the module. The value of the business's assets must always equal the value of the capital used to finance the purchase of the assets. That's liabilities plus equity. So the balance sheet must always be in balance. So let's look at a very simple example to show how a balance sheet works. Imagine that on 31st of December 20x1, Company X prepares its balance sheet. The company reports that it has £100 worth of assets, things like cash, inventory or equipment. It also owes £60 of liabilities, for example, loans or unpaid bills to suppliers. That leaves £40 worth of equity, the owner's share of the business after paying its debts. So we have £100 worth of assets, £60 worth of liabilities, and £40 worth of equity or capital, as it's also known in sole trader businesses. So the key equation behind the balance sheet is that assets equals liabilities plus equity. And in this case, the numbers balance perfectly because £100 worth of assets equals £60 worth of liabilities plus £40 worth of capital, which equals £100. So anyone looking at the balance sheet can quickly understand what the business owns, what it owes, and how much value belongs to the owners. So why is the balance sheet so important? It helps stakeholders understand the resources a company has, what it owes, and what's left for the owners. It's a vital tool for assessing the business's financial health and its stability and resilience. It also allows users to assess the business's ability to meet its short and long-term debt, i.e. its liquidity and its solvency. It assesses whether the business needs additional financing and how likely it is to secure that financing based on its current financial structure. By ascertaining the economic resources the business controls, users of the financial information will be in a better position to predict the entity's ability to generate future cash flow. A business's financial position at any given moment is shaped by several key factors. First, we look at the economic resources the business owns. This includes cash, inventory, equipment, and property. Next, we consider the financial structure of the business, i.e. how is it funded. This involves looking at the balance between borrowing, known as liabilities, and the owner's investment in the business, known as capital. Another important factor is the business's liquidity and solvency. Liquidity tells us whether the business can meet its short-term commitments, like paying suppliers and wages on time. Solvency, on the other hand, is about the business's ability to meet its longer-term debts and obligations. And then finally, we need to think about the business's ability to adapt to its environment. How flexible is the business in responding to changes in technology, market conditions, regulation, or even the wider economy? So together, these factors give us a well-rounded view of a business's financial strengths, its risks, and its capacity to grow and succeed over time. These factors will illustrate how and why the balance sheet is one of the most important tools for financial decision making. So let's now explore the statement of profit or loss, often referred to as the income statement. The income statement plays a crucial role in helping us understand a business's financial performance over a period of time. At its core, the statement comprises income, which is money earned from sales or services, with expenses, the cost of running the business. If income is greater than expenses, the business reports a profit. If expenses are higher than income, it shows a loss. Income statements are typically produced annually and are incredibly useful for comparing performance across different periods. So in short, the statement of profit or loss tells us how much the business earned, how much it's spent on costs, and whether it's financially heading in the right direction. Let's look at a simple example of how the income statement or profit and loss account actually works. So for the period ending 31st of December 20X1, Company X reports that it generated £50 of revenue from its sales, but during the same period it incurred £40 worth of expenses. These could include things like wages, rent, materials, or utility bills. After subtracting the expenses from the revenue, we're going to be left with a profit number of £10. The profit figure represents the money the business has earned after covering all of its running costs. The income statement provides a clear picture of how well a business has performed financially over a specific time period, showing whether it's made a profit, broken even, or suffered a loss. The statement of profit or loss is more than just a summary of income and expenses. It's one of the most important tools for understanding how well a business is performing financially. In particular, it allows users to assess the financial return that the business has generated from the assets it owns. It can help evaluate how effective management is at using those resources. This is sometimes called assessing stewardship, and it helps make informed predictions about the business's future profits based on past and current profitability. The income statement also connects directly with other key financial statements. For example, the balance sheet and the income statement can be linked together through the cash flow statement and the changes in equity. The statement of cash flows shows how profit translates into cash movements, while the SOCI reflects how profits are retained or distributed amongst owners. Finally, let's take a quick look at how financial statements are presented. It's easy to look at a balance sheet or an income statement and just see a list of large numbers, but behind every line in those financial statements are countless individual transactions. For example, total revenue is the sum of all the sales that have been made during the year. The trade payables balance represents the total amount the company still owes to its suppliers at the reporting date. What we see on the face of the financial statements are just aggregate numbers. Also, financial statements are only as reliable as the data that feeds into them. If the underlying transactions aren't captured accurately, the statements themselves can't be trusted. That's why one of the key responsibilities of directors is to ensure that the financial statements present a true and fair view of the business's financial position and performance. And in today's world, the vast majority of businesses use computerized accounting systems to record and process its transactions. Accounting software helps reduce errors, improve efficiency, and automate many parts of the accounting process. Cool. Let's take another look at another question. Which financial statement provides a snapshot of a business's financial position at a specific point in time? Is it the statement of profit or loss, the statement of cash flows, the statement of changes in equity, or the statement of financial position? So as the phrasing of the question suggests, the correct answer to this question is the statement of financial position. The balance sheet lists out the assets that the company controls, the liabilities it owes, and the equity or the capital which is held by the owners. It's the go-to financial statement for understanding and assessing a company's financial stability on a specific date. When we think about how a business spends its money, we can broadly divide expenditure into two main categories. We have capital expenditure and revenue expenditure. And understanding the difference between these two types of expenditure is really important because they're accounted for very differently. We'll start with capital expenditure. This refers to money spent on acquiring non-current assets. These are assets that the business expects to use for more than 12 months. And this might include things like buildings, vehicles, machinery, or IT systems. And the key point is that capital expenditure doesn't just maintain the current operations of the business. It's all about enhancing the business's earning capacity. These are long-term investments designed to help the business grow or operate more efficiently in the future. Now, compare that to revenue expenditure. Revenue expenditure is all about the day-to-day running of the business. It covers the costs involved in keeping the business operating smoothly. It's things like wages, rent, utility bills, administrative costs, raw materials, repair and maintenance costs, interest expenses. Rather than improving or expanding the business, revenue expenditure simply allows the business to maintain its existing level of activity. So in simple terms, capital expenditure is a long-term investment in the business, whereas revenue expenditure is a short-term cost that keeps the business ticking over. Now that we've looked at the differences between capital and revenue expenditure, let's explore how they're both accounted for. So we'll start with revenue expenditure, as this one's a little bit more straightforward. Revenue expenses like wages, rent, raw materials are seen as part of the ongoing costs of running a business. Therefore, they're immediately charged as an expense in the income statement. For example, if a business pays its staff wages, those wages will be immediately charged in full as an expense, which reduces the profit reported in the income statement. There's no delay, revenue expenditure is sent straight to the income statement and it never appears on the balance sheet. Now let's contrast that with capital expenditure. When a business purchases a non-current asset like a machine, a vehicle or a building, that asset is not expensed straight away. Instead it's capitalised, meaning it's recorded as an asset on the balance sheet because the benefit from the asset, i.e. the revenue that it's going to earn, will last for more than one accounting period. However, over time, the value of that asset reduces as it's used within the business. The reduction in the value of the asset is recognised as depreciation. This is a way of spreading the cost of the asset over its useful life. And the depreciation expense does appear in the profit and loss account. But it's more gradual. It happens over several years. It does not happen all at once like revenue expenditure. This ensures that the cost of purchasing the asset is matched against the income it helps to generate across its useful life, which for non-current assets can be many, many years. So, to summarise, revenue expenditure goes straight to the income statement. It's recognised as an expense in the period that it's incurred, whereas capital expenditure first is recognised on the balance sheet as a non-current asset, and then it gradually moves over to the income statement as an expense via depreciation. So let's bring revenue expenditure to life with a practical example. Imagine a business buys 12 wooden planks, paying £240 in total. That's £20 per plank, 12 planks. These planks are inventory as they're items the business buys with an intention to sell. But during the period, the business sells 9 of them, which means that the cost of goods sold is £20 per plank times 9 planks, which equals £180. This amount is treated as revenue expenditure because it directly relates to the sales of goods in the accounting period. So it goes to cost of goods sold in the income statement. But what about the 3 planks that weren't sold? Well, their cost is going to be £20 per plank times 3 planks is £60. This cost is not expensed during the period. Instead, it's shown as inventory on the statement of financial position. So it's important to understand that the entire £240 that was spent on trading stock is classified as revenue expenditure. The key thing to understand though is when that expenditure is recognised. £180 worth is recognised in the income statement in the current period because 9 planks have been sold. So that £180 needs to be recognised as cost of goods sold. Whereas £60 worth is not going to be recognised in the income statement in the current period. For now, it's going to sit on the balance sheet as inventory, and it'll be moved to the income statement when it's sold. Now let's look at an example which brings together both capital and revenue expenditure. So imagine a business purchases a building for £400,000. That's a classic example of capital expenditure. So that's the initial cost of the building. The business is acquiring a long-term asset that will use for many years to come. So it's classified as a non-current asset on the balance sheet. It's capital expenditure. However, at a later date, the business decides to add an extension to the building that costs £150,000. That's also capital expenditure because it's enhancing the value of the building and it's increasing the earning capacity of the asset. So that's the cost of the extension. So the cost of the extension isn't just simple maintenance expenditure, it's not revenue expenditure, it's an improvement to the building that's increasing the business's usefulness over time and it's increasing its earning capacity. But then the business spends an additional £1,200 on painting, cleaning and minor repair expenses. So here's where the difference kicks in. That £1,200 is classified as revenue expenditure because it doesn't add anything to the building's value. Repairs. It's simply just maintaining the existing earning capacity of the building, keeping it in a usable condition. The repair costs aren't adding anything new to the building, they're just maintaining its current condition. So in accounting terms, this £550,000 total will be recognised on the balance sheet as a non-current asset. Meanwhile, the £1,200 will be recognised on the income statement as an expense straight away. This example shows the distinction between capital expenditure, which improves or extends the life of a non-current asset, whereas revenue expenditure just maintains the existing capacity of the asset. So when a business buys something like machinery or property, it doesn't just pay the purchase price of the item. There are additional costs, for example, delivery fees to get the asset to the business, installation costs to get it set up, and sometimes legal fees which are tied to the purchase. But how are all these costs classified? Are they capital or are they revenue expenditure? So the general rule of thumb around this is that the costs that are directly related to getting the asset ready for use are treated as capital. And they're added to the value of the asset on the balance sheet. But if the cost is part of ongoing maintenance, then it's going to be revenue expenditure, and that goes straight to the income statement. So if we look at the example of a machine purchase in this table, we can see that delivery costs, installation costs, legal fees are all tied to the purchase of the machine, so they're all capital in nature, whereas fuel costs, maintenance costs are all revenue as they aren't tied to the purchase. They're ongoing costs that need to be incurred continually, even years after the initial purchase was made. So capital expenditure brings something new or improved into the business, providing long-term benefits, whereas revenue expenditure simply helps maintain the business's current earning capacity. So let's now talk about capital income. Capital income is the money a business earns when it sells a non-current asset like machinery, vehicles, buildings that are no longer needed. They're not day-to-day sales that generate the business's core revenue, but rather one-off, unusual transactions that occur infrequently. For example, if a business sells a delivery van it no longer uses, the income from that sale will be categorised as capital income, and it'll be recorded in the income statement. It's not part of the business's regular trading activity. They don't exist to sell delivery vans on a day-to-day basis, so if that's the case, the income will be categorised as capital. In contrast, we have revenue income. This is the core income that's earned from a business's day-to-day operations and activities. This includes money received from selling goods, providing services, or earning interest and dividends. Revenue income is what we think of as the business's main recurring source of revenue. And again, this is also included and recorded in the income statement. So for example, if a retailer sells £10,000 worth of products off its shelves every month, that's classed as revenue income. If it receives £500 in bank interest or dividend from shares, that's revenue income also. So to summarise, capital income comes from selling non-current assets the business no longer needs, and it's typically associated with a one-off event. Revenue income, on the other hand, is the regular income the business earns from its core activities, and both of these types of income are recorded in the income statement. So let's make the distinction between capital and revenue income crystal clear by looking at a table which compares the two. Capital income is earned from selling non-current assets, things the business owned for the long term but no longer needs, things like machinery, buildings, and again, these are typically one-off events and they're not part of the business's regular trading. Whereas revenue income, in contrast, comes from the day-to-day core activities of the business and includes income from selling goods, selling services, or from investment returns. It's the regular cash flow that keeps the business going. Both types of income appear in the statement of profit or loss, but they tell different stories about the business. One is about growth and disposal, the other is more about operations and income sustainability. So understanding the difference is really important when preparing and interpreting financial statements. So alongside the income and expenses from trading activities, businesses are also involved in what we refer to as capital transactions. These are financing activities, transactions which relate to how the business is funded, not related to how it makes money and earns profits. So common examples of capital transactions include raising additional funds from the owner or shareholders by issuing new shares, so increasing the company's share capital, taking out a loan, so borrowing money from a bank or another lender, repaying a loan, so reducing the amount owed to lenders by paying off existing debts. And what's important to understand about these transactions is that they do not appear on the income statement because they're not part of a company's financial performance. Instead, they affect the balance sheet because they change the business's financial structure, either its capital or its liabilities. These activities either increase or decrease the cash available to the business on the asset side of the balance sheet, and they also impact the capital side and the liability side as well. So let's take a look at how this works in practice. When a business raises equity by issuing new shares, cash increases, and at the same time share capital, which sits within the equity section, also increases. When the company or business takes out a loan, cash increases, but so does the company's or business's liabilities because the loan will need to be repaid in the future, so it's categorized as a liability on the balance sheet. And when the business repays a loan, cash is going to decrease, but so does the loan balance. So these movements help fund the business's operations and growth, but they don't directly impact profit, which is why they're reported on the balance sheet, not the income statement. Understanding these capital transactions is really important because they explain where the money is coming from to fund the business and how it's able to purchase its assets. So you may be wondering, why does it matter whether something is capital or revenue in nature? Well, in accounting, the correct and consistent classification of income and expenses ensures that the business correctly calculates its profit in each reporting period. If we wrongly treat a capital expense as a revenue one or vice versa, it could seriously distort the accounts. We might accidentally overstate profits, understate assets, or even end up misleading investors, regulators, or tax authorities. So this is why the terms capital and revenue are used consistently in financial reporting standards and why understanding them is actually really practically quite important. So get comfortable with the distinction between capital and revenue income and expenditure now, because they're going to keep coming up throughout the course of your accounting journey. So here's a quick knowledge check. Which of the following is considered a revenue item in accounting? Is it the purchase of a new delivery van, income from selling old office equipment, legal fees for buying a property, or wages paid to employees. So the correct answer to this question is D, wages paid to employees. This is a classic example of revenue expenditure because wages relate to the day-to-day running of the business, and therefore wages aren't capitalised, they're not treated as an asset on the balance sheet, they're just treated as expenses and they go through the income statement immediately. In terms of why the other options are incorrect, A, buying a delivery van, that's capital expenditure. Option B, selling office equipment, that's capital income. And C, legal fees when purchasing property, that's also capital expenditure because it's directly linked to acquiring a non-current asset. So remember, revenue items are all about ongoing operations, whereas capital items are linked to buying, improving, or disposing non-current assets. At the heart of financial reporting lies the conceptual framework for financial reporting developed by the International Accounting Standards Board. The framework sets out the basic principles and objectives that underpin how financial information should be prepared and presented. It provides a foundation for the development of accounting standards and offers guidance for accountants in situations where no specific standard applies. Importantly, the framework helps ensure that financial reporting remains useful, consistent and reliable so that users of financial statements can make informed decisions based on clear and comparable information. To be useful for investors, the conceptual framework defines two fundamental qualitative characteristics that all financial information must have: relevance and faithful representation. Relevance is about whether financial information makes a meaningful difference or not. Relevant financial information helps users make informed decisions, such as predicting a business's future financial performance. If a piece of financial information doesn't influence an investor's decision, then it's not considered relevant. And then the second fundamental qualitative characteristic, faithful representation, means that information in the statements must be honest and it must be accurate, showing what really happened in a clear and truthful way, without leaving any important information out or introducing bias or trying to mislead the user. So for information to be useful, it needs to be both relevant and it needs to be faithfully represented. These are the two fundamental characteristics under the conceptual framework. And alongside these, there are four enhancing characteristics that further improve the quality of financial information. You've got comparability, which means that financial information should be prepared consistently so that users can easily compare financial performance over time for the same business and between different businesses at the same point in time. Verifiability, which means that information in the financial statements can be checked by looking at supporting evidence. Timeliness ensures that information is provided to users quickly enough to be able to influence their decisions. If it takes too long to reach users, that information may become stale and not be decision useful. And then finally, understandability, which means financial information should be presented clearly. It should use straightforward language so that users can easily grasp the key messages. So together, these characteristics ensure that financial information is useful, it's trustworthy, and it's decision relevant. So let's look at one of the fundamental qualitative characteristics of financial information. We'll start with relevance. This is the first characteristic. In simple terms, information is relevant if it's capable of making a difference to the decisions made by users. Think of an investor deciding whether to buy shares in a business. If the information in the financial statements influences their decision, then it's relevant. For information to be relevant, it should have predictive value, confirmatory value, or ideally both. Predictive value means that the information helps users make forecasts about what might happen in the future, whereas confirmatory value means the information can be used as feedback to confirm or correct past predictions and assumptions. And a key part of relevance is the concept of materiality. Information is considered material if leaving it out or getting it wrong could influence the decisions made by the people relying on the financial statements. Whether something is material depends on both the size of the item and its nature. What might be material for a small business could be immaterial for a large corporation. So, to summarise, relevance helps to keep financial statements focused on what truly matters, providing decision makers with meaningful information rather than cluttering the reports with unnecessary levels of detail. The second fundamental characteristic of useful financial information is faithful representation. This means that the information in the financial statements must accurately reflect the transactions it's meant to represent. It's not enough for information to just be relevant, it also needs to be trustworthy. To achieve faithful representation, the information needs to have three essential qualities. Firstly, it must be complete. This means that it includes all the information necessary for a user to fully understand what's being reported. Nothing important should be left out of the financial statements. Second, the information needs to be neutral. That means that the information must be presented without any bias, no cherry picking of numbers or presenting things in a way that favours one outcome over another. Neutrality is also closely linked with the idea of prudence, and prudence in accounting is the idea of making judgments that don't lead to an overstatement of assets or income, and avoiding understating liabilities and expenses. Thirdly, the information needs to be free from error. That doesn't mean that the information needs to be perfectly accurate, i.e. every number needs to be absolutely 100% correct to the nearest decimal point, but what it does mean is that there shouldn't be any material mistakes or omissions, with the key word being material. Together, these three qualities ensure that the users can rely on financial statements when making important decisions about the business. Now that we've looked at the fundamental characteristics, we can turn to the four enhancing qualitative characteristics of accounting information. The conceptual framework states that financial information that is relevant and faithfully represented can be made even more useful by applying the following four enhancing qualitative characteristics. The first of which is comparability. This characteristic helps users compare financial information across different entities or reporting periods. Valid comparisons should be able to be made with information from prior periods and information prepared by the business's competitors. So, for example, an investor comparing two different companies in the same industry wants to be sure that they're using the same accounting methods, so the comparison is valid. Comparability is supported by applying consistency, using the same accounting policies and frameworks over time. Next, we have verifiability. Verifiability gives users confidence that the information faithfully represents what it claims to be. If something is verifiable, it means different independent experts could examine the same piece of financial information and come to the same conclusion. The information contained within the financial statements can be backed by supporting evidence. Third, we have timeliness. The information needs to be made available to the user in a timely manner. Even the most accurate and relevant financial information will lose value if it arrives too late. Timely information helps users make decisions when they need it, not if it arrives far too late. And finally, understandability. This means presenting financial information clearly, logically, using straightforward and easy to understand language. It assumes that users have a basic understanding of business and finance, but it still aims to remove unnecessary complexity from the explanations included in the financial statements. So together, these four enhancing characteristics work alongside the two fundamental characteristics, ensuring financial information is useful to those people that rely on it. So here's another question to test your understanding of materiality. Materiality is an entity-specific aspect of which qualitative characteristic? Is it understandability, verifiability, faithful representation, or relevance? So the correct answer here is relevance. Materiality refers to whether information is significant enough to influence the decisions of users, and materiality is not a separate characteristic on its own. It's actually part of relevance. So according to the conceptual framework, information is deemed relevant if it can make a difference to the user's decisions. Whether something is material or not helps determine whether that information is relevant. So materiality sits under relevance as a filter for deciding what needs to be included within financial reports. Before we dive into the details of how financial statements are prepared, it's important to pause and consider the key assumptions that underpin everything we're about to learn. These fundamental assumptions provide the foundation for how financial statements are prepared and understood. Think of them as like the rules of the road, designed to ensure that financial information is presented in a way that's fair, that's consistent, and reliable. These assumptions are set out in IAS 1, the international accounting standard that deals with the presentation of financial statements. IAS 1 is a key part of the conceptual framework. And in this section, we'll focus on the fundamental principles, because once you understand the assumptions, the structure and logic of financial statements will start to make much more sense. The first thing to understand about IAS 1 is why it exists. The primary objective of IAS 1 is to outline how we should present a generic set of financial statements. Financial statements are designed to be useful to a wide range of users, especially those who aren't in a position to request customized, tailored financial reports, which are made only for their use. And the key focus here is on comparability. IAS 1 helps ensure that financial statements can be compared, not only across different time periods for the same business, but also between competitors in the same industry. This makes it easier for users like investors, lenders, regulators to understand and analyze financial information wherever it comes from. In short, IAS 1 sets the stage for consistent and comparable financial reporting, helping to support informed decision making across the business world. So, what exactly is the purpose of financial statements? Why do they matter? At their core, financial statements are designed to provide key information about an organization's financial position, its performance, and its cash flows. This information is crucial for a wide range of users, from investors, lenders, regulators, and other broader stakeholders, all of whom rely on these financial statements to make informed economic decisions. Financial statements also play an important role in demonstrating management stewardship, showing how effectively they have used the resources that have been entrusted to them. Perhaps most importantly, these statements help users to predict the entity's future cash flows, giving insights into both the amount and the timing of these cash flows and how certain they are likely to be. To meet these objectives, financial statements must report on several key areas: assets, liabilities, capital, income, and expenses. They also report on changes in equity and cash flows. Together, these elements give users the complete picture they need to understand the financial health of the business and to support sound decision making. The preparation of the financial statements is the responsibility of the board of directors. One of the most important principles in financial reporting is fair presentation. Fair presentation means that the financial statements must be a faithful representation of the company's financial position, performance, and cash flows, accurately reflecting all of the transactions which took place during the accounting period. Under IAS 1, compliance with IFRS accounting standards is presumed to achieve fair representation. And to achieve fair presentation, IAS 1 highlights three key requirements. First, the correct selection and application of accounting policies. Second, the presentation of information in a way that's relevant, reliable, comparable, and easy for the user to understand. And finally, providing additional disclosures where needed so that the users have all the information required to properly understand the financial position and the performance of the entity. Together, these three elements help ensure that financial statements give a true and fair view, allowing users of the information to make better decisions. Although financial statements are normally presented in line with IFRS, IAS 1 recognises that in very rare cases, strict compliance with a particular standard might actually result in financial statements that are misleading. In these situations, a departure from IFRS may be necessary if doing so will achieve fair presentation. But this isn't something that can be done lightly, so IAS 1 sets out very clear requirements for what must be disclosed when a departure from an accounting standard takes place. So first, management must confirm that even with the departure, the financial statements still fairly present the entity's financial position, performance, and cash flows. Second, there must be a clear statement that all other IFRS standards have been adhered to, except for the one that's being departed from. Thirdly, the business must explain the nature of the departure, why following the standard treatment would be misleading, and what alternative approach has been taken. And finally, the financial effect of the departure must also be disclosed. So remember, departures from IFRS are very rare, and they're only permitted where they're absolutely necessary to achieve fair and faithful presentation. Let's now discuss one of the key principles in accounting, the going concern assumption. Applying the going concern assumption means that when we prepare a set of financial statements, we're assuming the business will continue operating as normal into the foreseeable future. Typically for at least 12 months from the reporting date. In other words, we're assuming that the business has no plans and no need to shut down, liquidate its assets, or cease trading. If a business is not a going concern, that would mean that the business is unlikely to continue trading, perhaps because it's facing severe financial difficulties, insolvency, or plans to liquidate its operations. So why does the assumption that a business is a going concern matter? Well, when accountants prepare financial statements, they need to make certain assumptions about the future of the business, and the going concern assumption is the most important. When we are confident that a business will continue operating for at least another 12 months, we can prepare the accounts on what's known as a going concern basis. This means that the assets like machinery, vehicles, or inventory are valued based on their use in the business, not on what they could be sold for in a fire sale. The same goes for liabilities. We treat long-term loans as payable over their agreed term, rather than expecting that everything would need to be paid off immediately. And this is the key point. If the going concern assumption does not apply, if there's a very real possibility that the business might close within the next year, then the financial statements must be prepared on a breakup basis, and the values we report in the accounts will look very different because we'll be focusing on what the assets are worth if the business were to shut down and we were to sell them in a fire sale, or if we were to send them to scrap. Therefore, the going concern assumption plays a crucial role in giving a true and fair view of the financial health of the business. When a business is treated as a going concern, we assume it will continue to operate normally. In this case, assets are valued based on what they're worth in ongoing use, such as their historical cost or fair value. Liabilities are recorded as payable according to their normal terms. But what happens if a business is not considered a going concern and there are signs that it might not survive for the next 12 months? Well, in that situation, we can't prepare the financial statements using the going concern assumption. Instead, we use what's known as the breakup basis, which has a significant impact on how we report the business and its assets and its liabilities. And under the breakup basis, we assume that the business is going to close down, and therefore its assets are going to need to be sold off immediately. This means we no longer value assets based on their use within the business. Instead, we're going to ask the question, how much could we realistically get for these assets if we were to sell them quickly in a forced sale? Often those forced sales take place at a discount, and this is known as net realisable value. And net realisable value is usually much lower than the original purchase cost of the asset. So the same thing applies to liabilities. Under the breakup basis, all debts are assumed to be payable within 12 months. There's no distinction between short and long-term assets and liabilities. Everything is treated as current. So to summarise, under the going concern, we assume the business is stable and is going to continue trading. Under the breakup basis, we assume the business is closing down. Assets are valued at what they could be sold for quickly, and all liabilities are treated as immediately due. This shift has a huge effect on the financial statements and on the message those statements send to investors. That's why it's so important to determine whether the going concern assumption applies for a business. So let's take a look at how the going concern assumption works in practice. Imagine a bakery that sells coffee machines. They purchase 50 machines, paying £200 each. During the year, they manage to sell 40 machines at £350 each. They have 10 unsold machines at the end of the year. The key question for us is, what value should we place on the 10 machines in the financial statements? Well, the answer really depends on whether the business is a going concern or not. If the bakery intends to keep trading into the next year, we continue to value the remaining machines at their cost price of £200 each. That's because they're still part of the business's operations. We expect to sell them at their usual selling price in the future. Therefore, the value of the inventory on a going concern basis is going to be £200 multiplied by 10 units equals £2,000. However, if the bakery is forced to close down, then those machines will have to be sold off quickly in a fire sale. They might only fetch £120 each. Therefore, the value of the inventory on a breakup basis is going to be £120 times 10 units equals £1,200. In this case, the value of the stock falls because we're no longer thinking about normal business operations. We're thinking about what the assets would be worth in a breakup scenario. So this example should hopefully help demonstrate just how important the going concern assumption is. It directly affects the figures we report in the financial statements. So what happens if the going concern assumption doesn't apply? Because there are serious doubts regarding the business's ability to survive into the future. Well, in these cases, the business can't carry on preparing its financial statements as usual. Instead, there are clear rules about what must be done to keep the accounts transparent and reliable. First, the business must clearly state the basis of preparation it's used. This means explaining to the user that the financial statements have not been prepared on a going concern basis and confirming that the breakup basis has instead been used. Secondly, the business must provide the reasons why the going concern assumption is not appropriate here. This could be due to major financial difficulties, loss of key customers, failure to secure funding, legal issues, or any other significant issue that casts serious doubt over the business's ability to keep trading. Third, if there is material uncertainty, in other words, if it's not absolutely certain whether the business will survive or not, but there's enough of a doubt to raise concern, this uncertainty must also be disclosed clearly in the notes to the financial statements. So the purpose of this disclosure is to ensure that stakeholders and users of the financial statements are not being misled. Investors, lenders, suppliers, and others need a clear picture of the risks facing the business so that they're able to make informed decisions. If a business at risk of closure fails to disclose this fact to the users of the financial statements, it could lead to poor decisions being made, financial losses, or even legal consequences. That's why full and honest disclosure is essential whenever the going concern assumption doesn't apply, or when there's significant uncertainty regarding whether it applies or not. There are two types of accounting approaches. Accrual accounting is where we record transactions when they happen, not when the cash actually changes hands. So if a business sells goods to a customer today but won't be paid until next month, we still record that as income now when it's earned. The same goes for expenses. Even if we haven't paid the bill yet, we account for the cost in the period it relates to. This is different from cash accounting, where we only record income or expenses when cash is received or paid out. Accrual accounting is the system used to ensure that financial statements reflect the true financial performance of a business based on when transactions happen, not when the cash changes hands. This method gives a much clearer picture of how the business is performing because it matches the recording of transactions to the economic activity, not cash flow timing. Now let's talk about the matching principle. This is an extension of accrual accounting. Put simply, the matching principle states that expenses should be recorded in the same accounting period as the income they help to generate. Why is this important? Well, it's all about making sure we're comparing apples with apples. We want the costs of doing business to sit side by side with the income those costs help to generate. So we get a fair and accurate picture of profitability for the accounting period. So on the slide, we've got a quick example. Imagine a business sells a product in December but doesn't pay the supplier it initially purchased the goods from the cash it owes until January. Under the matching principle, the cost of these products still needs to be recorded in December because that's when the sale happened and that's when the revenue was earned. Without the matching principle, it would be far too easy to give a misleading impression of how profitable a business really is. The matching principle makes sure that revenues and expenses are properly aligned, helping us tell the full story of a business's financial performance. So, in this slide, let's walk through an example to understand how accrual accounting works in practice. We have a sole trader who buys 30 mobile phone cases on credit, each costing £6. So the purchases for the period are equal to £6 times 30 cases equals £180. By the end of the year, they've sold 25 cases, also on credit, for £12 each. So this generates £300 of sales income. But here's the key point. Under accrual accounting, we don't charge the full £180 worth of purchases to the income statement during this period because 5 of the cases haven't been sold yet. They're still sitting in inventory. So instead, we need to match the income from the 25 cases sold, that's the £300, against the cost of those 25 cases, which is equal to £6 times 25 cases equals £150. So that gives us a profit of £300 deduct £150 for the period equals £150. What about those 5 unsold cases? They stay on the balance sheet. They're going to be carried forward as inventory, so that's valued at £30. And since the suppliers haven't been paid yet, the full £180 will appear on the balance sheet as a trade payable. The £300 worth of sales income is also going to sit as a trade receivable, as the customers haven't paid for those goods yet, they were purchased on credit, and £150 worth of profit will go to retained earnings. So what's the key takeaway from this example? Only the costs of goods actually sold during the period should appear on the income statement, not total purchases. That's how accrual accounting gives us a fair and accurate view of the performance for the period. However, what happens at the end of the period if the business is no longer deemed to be a going concern? Inventory, for example, will no longer be recorded at purchase price. Instead, we'll look at how much we could realistically sell those 5 items for in a fire sale. So if we bought those 5 unsold phone cases for £6 each, but in a fire sale we could only get £3 for each phone case, we now would have to revalue that inventory at £15 instead of £30. So again, the going concern concept is vital because it affects how much we value the business's assets at, and whether we assume they'll be sold in the ordinary course of business or in a liquidation. Now let's take a moment to look at an alternative to accrual accounting, something called cash accounting. Cash accounting is a simpler approach where we only record income when the cash is received, and we only record expenses when cash is paid out. The method can be much easier to use than accrual accounting, especially for smaller businesses who are sole traders, who may not have complex accounting systems in place. It's more intuitive. After all, it matches how many people manage their personal finances, right? Tracking money as it moves in and out of the bank account is typically how most people think about their business. For small businesses, particularly those with limited cash flow, cash accounting can be really useful for managing day-to-day finances and for making tax payments. And one key advantage of cash accounting is that a business won't have to pay tax on its profits until the cash is actually received. Under accrual accounting, tax could actually end up being due on sales income, even if the customer hasn't received the cash from those sales yet. That's why cash accounting is often available as a choice for smaller businesses, particularly in their earlier years of trading. So let's have a look at the same phone case example now, but this time through the lens of cash accounting. So the sole trader purchases 30 phone cases on credit, costing £180 in total, but the catch here is that they haven't paid the supplier yet. On the sales side, they sell 25 cases at £12 each, making £300 worth of sales, but those customers haven't paid yet either. So under cash accounting, none of these transactions are recorded in August. They record 0 revenue and 0 sales because no money has actually changed hands, no cash has been exchanged. But if we fast forward to September, say that the trader pays the supplier £120 for 20 cases, and 12 customers pay their invoices, generating £144 in cash sales, what gets recorded? Well, we have £144 worth of revenue, £120 worth of cost of sales, and therefore we generate £24 worth of cash profit. And that revenue, that cost of sales and that profit is solely based on cash movement in and out of the business. So the key takeaway is that under cash accounting, we only record income and expenses when the cash is actually received or paid. So this example hopefully illustrates and highlights a key point, that cash flow and profit aren't the same thing. A business can appear profitable on paper, but if it receives cash from customers after it needs to pay its suppliers, it could run into very serious cash flow issues, even going concern problems. So for example, if the business needed to pay £120 to its suppliers in September, but doesn't collect its receipts from its customers until December, it won't be able to cover its costs from its sales, so it will need to find cash to pay its suppliers from elsewhere, and that's not always easy. Another important concept in accounting is the consistency principle. Consistency means that financial statements must be presented in the same way from one period to the next. Line items should be classified and grouped consistently so that results from one year can be easily compared to the next. This principle helps users of the financial information to clearly see how a business is performing over time. It helps enhance comparability between different businesses, making financial information more reliable for decisions. However, there are some situations where a change in the presentation is allowed or even required. For example, if the nature of a business and its operations changes significantly, or if a review of the financial statements shows that a different presentation would give a more appropriate and accurate view, then the business is allowed to change the way it presents its financial performance. In some cases, changes in presentation may also be required by an IFRS standard. So the key message here is that consistency builds trust and clarity within financial reporting, but businesses are also allowed to change their presentation approach if it will improve clarity and understanding for those users of their information. Financial information is considered to be material if leaving it out or getting it wrong could influence the decisions that users make. Materiality depends on both the size and also the nature of the transaction. A very large transaction is likely to be material simply because of its size, but even small transactions can be material if they relate to sensitive or significant things like directors' remuneration or loans to directors, where transparency is absolutely crucial. In practice, any material transaction must be presented separately in the financial statements. This helps ensure that important information doesn't get buried inside vague categories like other expenses, other income, or accounts like that. Materiality also supports one of the fundamental qualitative characteristics of financial reporting, which is relevance. Finally, there's no strict formula or absolute rule for what is and isn't material. It's really a matter of judgment based on what could reasonably be expected to influence the decisions of users. So when preparing or reviewing a set of financial statements, always ask yourself the question, would this information make a difference to the people who are relying on these reports? If the answer is yes, then the information is material. Financial statements may look neat and organised on the surface, but behind those tidy figures lies a huge number of individual transactions. Aggregation is the process of grouping these transactions into meaningful categories, so the financial statements remain clear and readable and don't overwhelm the user. Transactions can be aggregated or grouped together based on either their nature, like rents, salaries, purchases of goods, or they can be grouped based on their function. So, for example, cost of sales or administrative expenses are examples of accounts that are grouped by function. So, for example, revenue, inventory, trade payables are all aggregated totals that combine lots of individual transactions into a single line item on the financial statements. These aggregated numbers are then presented on the face of the balance sheet and the income statement, so it's nice and easy to read for the user. Here's a simple example of how aggregation works. Imagine a business makes 5 separate sales in one day. One for £100, another for £200, another for £150, £250 and £300. Rather than listing each individual sale separately in the financial statements, these amounts are aggregated or added together and reported as a single figure, which is total sales for the day of £1,000. This approach helps keep the financial statements clear and easy to follow. It's also important to understand the link between aggregation and materiality. If a particular item in the financial statements is not material, meaning it wouldn't influence decision making on its own, it's often grouped together with other similar items. But if an item is material, it should always be presented separately to ensure transparency and not be aggregated to other transactions. It shouldn't be concealed within the financial statements. It should be able to be easily identified by the user. Next, let's look at the principle of offsetting. Offsetting means deducting one amount from another. For example, deducting liabilities from assets or expenses from income to show only the net amount in the financial statements. Under IAS 1, offsetting is generally not allowed because financial statements need to be clear, transparent, and easy to understand. Netting off income against expenses or assets against liabilities could conceal important details from investors. Instead, assets and liabilities need to be shown separately on the financial statements, and the same goes for income and expenses. They should be reported individually so that the full picture of the business's performance and position is visible to users of the financial statements. However, there are some exceptions to the rule. Offsetting is allowed when another IFRS standard specifically permits it, for example, in the case of certain financial instruments under IAS 32. It's also acceptable when the gains, losses or related expenses come from the same transaction and the amounts involved are immaterial. The key takeaway here is that offsetting should never reduce the usefulness of the financial statements. Transparency and fair presentation should always come first. So here's a quick example of how offsetting works in accounting. Imagine a business is owed £5,000 by a customer. This would be recorded as trade receivables, but the company expects that £500 of this might not be collected. So rather than showing the full £5,000 and then separately listing the £500 allowance, the business may offset the two amounts, reporting a net trade receivables amount of £4,500 on the balance sheet. This kind of offsetting helps keep the balance sheet a bit more clear and a bit more focused, but it's only allowed when accounting standards specifically permit it. Many items in the financial statements are measured at historical cost, but what does this actually mean? Well, historical cost refers to recording an asset at the amount that was paid for it when the transaction took place, when it was acquired, not what it might be worth today. So it's the amount that was paid by the business to purchase the asset originally. It's not current market value. For example, if a business buys a delivery van for £20,000, it will record that van at £20,000 in the accounts. Even if the market value of the van has increased to £50,000 today, you record it at historical cost of £20,000. Key benefit of using historical cost is objectivity. There's always a clear source document which backs up the historical cost amount, like an invoice or a purchase contract, which will support the amount recorded in the financial statements. This provides an audit trail and proof that the transaction really happened at that particular value. It's easier for accountants to deal with costs and values because costs are objective, whereas values are subjective. Let's now apply the concept of materiality using a practical example. A business buys a calculator for £10, expecting to use it over the next 10 years. Now, how should this be classified in the financial statements? Option A suggests recording it as a non-current asset since it has a long useful life. That seems reasonable, but let's not forget the amount is very small. £10 is quite a small amount to include as a non-current asset. Option B says treat it as a current asset since it's immaterial, but that's not quite right either. Current assets are expected to be sold, used or converted into cash within 12 months, which doesn't apply here. Option C suggests recording the calculator as an expense. Even though it lasts 10 years, £10 is an immaterial amount, so writing it off immediately to the income statement avoids unnecessary complexity. Option D says don't record it at all. That's definitely incorrect. It needs to get recognised somewhere in the financial statements. It's just not as an asset. So the correct answer here is option C. We apply materiality and treat the calculator as an expense. At first glance, financial statements might seem like they're just about hard numbers and concrete facts and strict rules. However, much of what appears in a set of financial statements really depends on the professional judgment of the accounting preparing them. Take depreciation, for example. Deciding how long a piece of equipment will be useful, i.e. its useful life, is not something you can simply look up. It's an estimate. And unfortunately, an unethical accountant may try to overstate or understate depreciation to achieve a desired financial result. The same applies to the valuation of a building. An unethical accountant may try to overstate its value to make the balance sheet appear stronger, perhaps to secure funding from a lender. Research and development costs are another area where judgment plays a key role. An unethical accountant could capitalise as much as possible to lower reported expenses and inflate profit. And provisions are another grey area. Accountants use judgment to estimate future obligations, and those estimates can be influenced to either boost or suppress profits in a particular period. This is why understanding the role of judgment in accounting is so important. It reminds us that accounting isn't just about technical accuracy, it's also about ethical decision making and professional responsibility. So we know that accountants use judgment to apply accounting concepts, but how do we make sure that this judgment is fair, consistent, and not open to abuse? The answer lies in ethics. Without ethical principles, professional judgment can easily be bent or manipulated. Two companies in the same industry group might apply the same rules very differently, not just because of interpretation, but sometimes to deliberately present a more favourable picture of the company's financial health, which would mean that two sets of financial statements are incomparable. So, for example, overstating asset values to make a balance sheet look stronger, or delaying expense recognition to boost profits in the short term. This is all why ethics is at the core of accounting. The ICAW Code of Ethics lays out the key principles and standards that all accountants are expected to uphold. By grounding professional judgment in these principles, we help ensure that financial reporting remains trustworthy, transparent, and comparable across organisations. Ethics provides the foundation for good judgment, and without them, the reliability of financial information would quickly fall apart. So, the ICAW Code of Ethics sets out 5 fundamental principles that all professional accountants must follow. First, we have integrity. This is all about being straightforward and honest in all professional and business relationships. Integrity is the foundation of trust. Next, we have objectivity. Accountants must always remain unbiased, not let personal interests or external pressures influence their professional judgment. Third, professional competence and due care. Accountants must keep their professional and technical knowledge and skills up to date, based on current developments in practice and in legislation, and apply their knowledge diligently to provide high quality work and professional services to their clients. Confidentiality is also vital. Information obtained during professional work must be kept private, never shared with third parties, and never used for personal gain or shared without clear authority to do so. Finally, professional behaviour. This means not doing anything you shouldn't. You must comply with laws, regulations, and avoid any conduct that could discredit the accounting profession. These principles guide how accountants should think, should act, and how they should make decisions, even in ethically complex situations. The ICAW's Code of Ethics isn't just about ticking boxes, it's about the values and standards that accountants are expected to live by, both professionally and personally. It's about acting in the public interest, maintaining the reputation of the accounting profession, and applying ethics to everything that you do, whether you're being paid for the work or not. One important idea here is that ethical guidance isn't limited to what's written in black and white. As professionals, we're expected to consider the spirit of the guidance, not just the letter of it. That means using our judgment to apply ethical thinking in all kinds of real-life scenarios. A great example of this is the principle of professional competence and due care. As professionals, we must make sure we have the knowledge and skills that we need to carry out our duties effectively. And if we don't, we have a responsibility to act within our limits. Maintaining competence is a continuous process. It requires ongoing learning, awareness of changes in legislation and professional standards, and it requires a commitment to quality in everything we do. In your exam, you may be presented with an ethical dilemma that requires you to identify which of these 5 principles has been breached, but more importantly, throughout your career, you'll be faced with real decisions where your ethical judgment is really going to matter. That's why this isn't just about exam technique, it's about thinking about the kind of professional you want to be. One of the more standout features of the ICAW's Code of Ethics is that it's built on a principles-based framework as opposed to following a more rigid rules-based framework. That might sound kind of subtle, but it makes a huge difference in practice. Instead of giving a checklist of do's and don'ts, the ICAW's principles-based system puts the onus on the individual accountant to assess each situation and apply their own judgment, acting ethically. Even if guidance for the exact scenario in question isn't written down in black and white. A principles-based system allows for accountants to apply the spirit of the code as well as the letter of the guidance. This approach prevents what we call legalistic thinking, where people try to work around specific wording in the rules without actually behaving ethically. With principles, the focus is on doing what's right, not just what's technically allowed. Another major benefit of a principles-based system is flexibility. Every situation is going to be different, whether you're working in audit, advisory, tax, industry. A principles-based system allows for professional judgment and interpretation that fits the context. So every situation is just very different. It's also incredibly well suited to a rapidly changing environment, like the one accountants work in today. Technology, regulation, business practices are all evolving fast, and a rules-based system is struggling to keep up. Of course, that doesn't mean anything goes. Principle-based systems can still include clear prohibitions where they're needed, for example, when independence or integrity is being compromised. So overall, this flexible but accountable approach helps ensure that ethical guidance stays relevant, effective and forward-looking, protecting both the public and the accounting profession as a whole. Let's take a moment to apply everything we've learned in this ethics section to a real-world scenario. Jordan is working as an auditor for a tech company called Pixel Tech Limited. During the audit, the CEO offers Jordan a brand new pair of premium noise-cancelling headphones as a thank you gift for the hard work. Sounds nice, right? But here's the question. If Jordan accepts the gift, which of the ICAW's ethical principles is most at risk? While integrity and professional competence might come to mind, the principle that's most directly threatened here is Jordan's objectivity. Objectivity means staying free from bias or outside influence, especially when making professional judgments. A gift, even a well-meant one, could compromise Jordan's independence and create a perception of a conflict of interest. So remember, maintaining objectivity isn't just about refusing gifts, it's about protecting your professional credibility at all times.